Yo, what's good YouTube? Welcome to another episode of the Timeframe Alignment Model. My name is Tom, I'm a full-time day trader, and today I'm going to be talking about market maker models. So if you struggle with knowing what PD array to pick, what side of the curve you are on, or even what kind of dealing range you should pick, this video is going to be for you. Also, don't be lazy and keep watching the entire video, don't skip. Let's get to work. Alright guys, once again, Timeframe Alignment Model, let's go over the syllabus. We've already covered 5 topics. Last topic was received very well, the daily bias topic, right? Make sure to watch it if you haven't. Now we're going to be talking about market maker models and mitigation area specifically. How do you actually trade market maker models? This is going to be divided up in 4 topics. What is a market maker model first of all? The phases of a market maker model, using the curves, and a mitigation sequence, how you can mechanically approach the market and wait for specific things, making it a lot easier to trade a market maker model as well. Now, what is a market maker model? If you're not aware, ICT's market maker model comprises of a original consolidation, which is an area where price builds up liquidity, typically has relative equal highs on the top as well, and then it starts to displace lower, forms a redistribution phase where price accumulates more orders to keep continuing pushing down, right? Because the market is not a one-sided direction, lower or higher. It has consolidation phases in between as well, retracements and reversals. That is the market cycle episode, right? We already discussed that, so go back into the series if you haven't. Then smart money reversal. This is where price reverses and goes into buy side of the curve. After we go into buy side of the curve, there will be a low risk buy. Now, why do they call it low risk buy? My interpretation of low risk buy means that if you trade this price leg, the initial leg that breaks the structure, you should put on low risk on this position. It's not because it's a low risk area to get in. I actually think it's a higher risk area to get in. Put on lower risk once you get in these types of moves over here. The next leg up for me is higher probability. Then a reaccumulation phase. This is where price accumulates orders again to continue pushing up. If you remember, I think it was the order pairing episode or the market cycle episode where we talked about continuation purge 1 or continuation pattern 1 and continuation pattern 2, right? This is what we're going to discuss as well in the charts here. Now, for a market maker sell model, the original consolidation is on the bottom, right? Because we have buy side of the curve, reaccumulation phase in between. Now, with market maker models, you typically only need an original consolidation or a relative equal low and a smart money reversal in a key level. That is the most important part of a market maker model because it typically it reaccumulates or redistributes in between the market maker model, but it can also be original consolidation straight up into a smart money reversal and then straight down as well. That should be a V-shaped kind of pattern. Doesn't occur too much because most of the time, especially on a higher time frame like a 4-hour or daily, you will see reaccumulation and redistribution phases. Let's go over the phases of the market maker model again. Like I just explained, we want to see these types of phases: original consolidation, reaccumulation and redistribution that happens in between the price legs, and then smart money reversal. This has to happen in a key level, and then the low risk buy and low risk sell. Low risk because it's, for me, it's riskier to get in, so you put on lower size on your position, so lower risk. So we got this Euro USD 4-hour chart. I'm gonna keep it simple and short and concise. So we just talk about the phases of the market maker model and we'll go deeper into it later in the episode. Original consolidation, very clear down here, right? Because there is a consolidation, relative equal lows. That's a nice area to target once you're on sell side of the curve. Then reaccumulation phase, so you can see price accumulates more orders. Same thing over here, price goes sideways, and notice how the bodies are compressed together, right? There's no real significant closure above the structure, so it's accumulating. Then we have a smart money reversal over here, another reaccumulation or redistribution phase rather, and then the low risk sell prints out of here. Even though this entire piece here is redistribution, the low risk sell can print out of it as long as it goes back to premium of the first dealing range. So pay attention, right? The first dealing range that forms the low risk sell. And then we have another dealing range and then price declines, taking out those relative equal lows. So these are the phases of a market maker model. How are we actually going to use the curves? This is going to be key in determining high probability PD arrays. Did you know that your chances of success will increase tenfold if you subscribe and like the video? Also, do you want to turn bald? That's what happens if you don't subscribe. Got a nice schematic over here, right? We know the original consolidation. That's what a market maker buy model starts off. If you're on sell side of the curve, then we're going to use the PD arrays that are resting on sell side of the curve. We're going to frame a PD array right, a discount array to buy from in the same area as that old selling happened. Old selling into new buying, that's what we would call it, right? And if we are in a market maker sell model, that would be vice versa, right? Then the curve would be mirrored. Then we would be calling it new buying into old selling, right? But this is a market maker buy model. Now we've got a T-bond futures 4-hour chart. Let's outline the phases of the market maker model here. It always starts off with an original consolidation. You want to have that original consolidation so you know, okay, this is the start of a market maker model. It's clear that this is the one extreme of the range, and then we're going to wait for a smart money reversal to occur on the other extreme of the range, right? The lowest point of the curve. This smart money reversal has to happen in a key level. You can't just take any low out of thin air because you think this will be the bottom. Just like here, you might have thought, oh, we're breaking structure over here, and now we're going into buy side of the curve. That makes no sense. You need to have a key level. Always trade with a key level if you're anticipating a smart money reversal. Look at this piece of price action over here. What happens every time we go and trade up higher or retrace higher? There are more sells accumulated by smart money, right? So all these up close candles here, over here, and this piece of price action over here is all selling area for smart money, because they push up the price, then they short it again, and then until they reach their terminus, they will offload their positions. Now in this same area, this is where we're going to use the curves. In the same area, we will be using a PD array to frame on the other side of the curve. How does that look like? We have this area of old selling. Now we can use this order block formed over here because it's in the exact same position here on the sell side of the curve. And then on the buy side of the curve, there is a set of down close candles formed here, which is a bullish order block. You can use the range that comes out of it. And then this should be the high probability order block. Another example over here, use the JPY 1-hour chart. Nice clear consolidation over here. One extreme of the range into another extreme of the range, right? Smart money reversal happens over here. Think about using one side of the curve to frame a PD array on the other side of the curve. So first example, this piece of price action over here, redistribution phase where price accumulates orders. Same thing over here, old selling, 2 up close candles, price pushes down afterwards. Then once we trade above it, we can use the same area over here as a old selling into new buying. So if there's a PD array formed in the exact same area where old selling occurred, then we can use that as a high probability PD array. So what we can see over here, we already formed the low risk buy. I'm not interested in low risk buy. I'm not going to lie. I always want to trade first stage distribution. Why? Because it confirms buy side of the curve. So that is way easier to trade rather than looking for an entry in the low risk buy area. That is my opinion. That's how I trade, and I love to do that way. So we can see that PD array formed over here, right? Bullish fair value gap, right in the same area as where old selling happened. And this is then the first stage distribution phase in the buy side of the curve on a market maker buy model. There can be multiple stages in a market maker buy model or market maker sell model. If you can spot another PD array, which is overlapping with the other side of the curve, and then you can find another high probability PD array. Look at this fair value gap here. This is where only sell side was offered, and it prints a fair value gap over here. Now we can use this area of old selling for a PD array on the other side of the curve. So if you draw out the lines of that fair value gap, we can see a order block formed right inside of this area, right? And this would be second stage distribution. Most of the time, the second stage distribution, aka the silver bullet, will have a volatile movement to finish off the market maker model. And you can see that over here. Price instantly displaces up higher once it taps that order block and then finishes the market maker buy model. Now let's talk about the mitigation sequence, because this mitigation sequence helped me so much in determining where I actually want to trade from. So when you're using the market maker models, you want to first of all wait for a low risk buy or a low risk sell to print. This is going to be key because I'm going to explain that when you are looking for an old area of buying and selling, you are wanting to be on the right side of the curve, and waiting for that low risk buy or low risk sell to form first gives you more confirmation that you are on the right side of the curve. Again, we're going to be looking for old area of buying and selling, and then we're going to be looking for an opposing array formed on the opposite side of the curve, and then wait for that new price leg to form out of it. Now this new price leg we can use as a range. So now you already know how to frame a range if you use high probability PD arrays, and you buy in discount and you sell in premium. It's that easy. So here we've got a Euro USD 15-minute chart, right? Blank chart. I just want you to look at this chart and just figure out, do you see any old buying into new selling or old selling into new buying areas? Mitigation sequence, think about that, right? So let's break it down. Original consolidation up here. one extreme of the range into another extreme of the range. Sell side of the curve, buy side of the curve. This looks very clean in my opinion because you have a nice extreme low. It has a V-shaped reversal. It's also a nice indication that you are going to have a reversal, because if it's consolidating, and we know from episode 4, right, market cycles, that price doesn't really reverse from a consolidation. Now I can already hear you think, hey, but what about the original consolidation in a market maker model? That is a good question. Listen, a lower time frame consolidation might be a higher time frame expansion phase. So think about that. Now, when you look over here, we've got SMT on the lows, which is nice to see if you want to have a strong low. This is where price dips down. This is a price leg down. Then it retraces, another price leg down. The retracement, like I explained earlier, this is where old selling and old buying happens, right? So this is old selling and then drops down. So we can use these specific candles in the retracement for a opposing array on the other side of the curve. So what does that look like? 2 up close candles where old selling happened is now an old selling into a new buying area. We have the low risk buy printed, and we can see a set of down close candles formed in that same area as well. Same thing over here. Price leg up, goes down, retracement goes down, retracement goes down. Every retracement with these up close candles can be an area of old selling into new buying. So if we draw it out to the right side of the curve, right, from sell side of the curve to buy side of the curve, we can see this area over here. If we form a set of down close candles, if we form a fair value gap in the same area, we can use this as a high probability PD array to look for more longs. Now this piece of price action over here, we already knew this is old selling. Can we spot something here that is for new buying? Yes, because we already know this range down here has been formed. And then we form the PD array in the same area as here, right? The bullish fair value gap. Now you draw out your range because you know you have a strong low because it's in an old selling into new buying area. Then you can draw out your range. I'm hoping you understand that the strong low is valid because there's SMT on the low and it forms in an area of old selling. This is key. Now you know how to draw out a correct range. This is how I do it. Once price comes back into discount, this is where you want to buy. If there's a PD array, you straight up take the PD array in discount. All right, let's go to another example. Euro Japanese yen, 15-minute chart, same thing. I want you to watch this chart. Just see if you can find this old selling into new buying or old buying into new selling. Where is the original consolidation? Let's put some lipstick on here. As always, we start off with an original consolidation. One extreme of the range takes out the high, and think about the order pairing episode, right? You need to watch every episode. Stop being lazy. So go to the other extreme of the range, right? Smart money reversal. And now we have a market maker sell model going on. So again, watch the price legs, right? Goes down over here, up, retracement, up. The retracements, again, this is where old buying or old selling is occurring. Now we want to wait for the low risk sell to print first because we're not interested in low risk sell. We want to trade in a distribution phase. It's way easier and we'll have a strong high and a confirmed sell side or buy side of the curve. What does that look like? We have an old area of buying because they're displacing price and leaving a fair value gap behind. Once there is a set of up close candles formed or another bearish fair value gap formed in the same area, this will be a high probability PD array. And you can actually see that, right? You can see 2 up close candles formed here and a fair value gap. Now price does not come back to premium. Shit happens. You're not going to take the trade. You're going to be patient and you're going to only sell in a premium. This is Euro JPY. So maybe GBP JPY went into premium and then it sold off. That is SMT, the cracking correlation. So that makes sense. If you are trading a single asset and it does not come back to premium, you don't take the trade. There's a hard rule. Now we have another area of old buying into new selling, right? It's that retracement to go higher. Down close candles, which should be a bullish order block, got violated, traded through, and then we form a set of up close candles. Bearish order block, right? And then we have another range down. And now notice how this one does go back to premium. So this is a good sell. Bearish fair value gap, taps premium, and then displaces down lower. This is the second stage distribution over here. So there's a volatile move down. And this is how you look for your trade setups and draw out your ranges. But guys, this was the market maker model episode. Hope you found it helpful. If you did, make sure to subscribe and like as always. And I thank you all for your support. Really like making these videos and hopefully helping all of you. And I will check you out in the next episode.